Hello, my name is John Pearce, Chief Investment Officer. Welcome to this update. Today, I'd like to recap on what was quite an extraordinary 2025 financial year. We'll discuss a few performance highlights. And finally, I'd like to explain how markets can stage such an impressive rally in a year when we had a fair share of bad news. On that point, what news actually made the headlines? Well, we had real wars, we had tech wars, and we had trade wars. Real wars, we all know about Ukraine and the Middle East, of course. In terms of tech, well, China sent tremors through the tech sector when it announced the launch of DeepSeek. You can think of DeepSeek as China's response to the ChatGPTs and those American AI models. Most importantly, DeepSeek was developed at reportedly a fraction of the cost. And finally, the biggest news of all, of course, was Liberation Day. And that's the day when Donald Trump pretty much announced tariffs on the rest of the world. Not surprisingly, all of this news sent markets on a roller coaster ride. What was somewhat surprising, however, is markets staged a pretty strong rally, and there's the ASX up about 14%. And that return was similar to what we saw in most developed markets. So how can markets rally so well against that backdrop of bad news? We'll get to that in a minute. Firstly, let's have a look at some option returns. On your screen, you have the full list of option returns. Now, I wish every July I could present a page like this. All numbers are positive. And most importantly, we're seeing risk being rewarded. So at the bottom of that table, we have our defensive options. And at the top of the table, we have our growth or riskier options. A few highlights here. Our balanced option, which of course is our default option in the Accum division, a very solid 10.3%. For pension members, that number was 11.5%. That is the third consecutive year our pension members got double-digit returns. Now, can we do it a fourth year in a row? Well, balanced options, I expect usually a return of between 7 and 8% over the long term, so they are over-earning. But 4 years in a row has been done before, 03 to 07. Then, of course, we had the GFC. What about the star performer of the year? Well, that's Australian dividend income. Now, the strategy in this option is basically investing in blue chip Australian shares that are expected to pay healthy, sustainable dividends. So it's supposed to be kind of boring, but there's nothing boring about those returns. How has it managed to do this? Well, the largest exposure in this option is Australian banks. It's about 33% of the option, and that was the best performing sector in the market. The option holds no mining companies, and mining was actually one of the worst performing sectors. I think the best way to capture the difference in the performance of these sectors is to actually have a look at the difference in the performance of the biggest company in each of these respective sectors. Of course, I'm talking about the CBA and BHP. First, Commonwealth Bank, or CBA. It returned an enormous 50% last year, which is extraordinary for Australia's largest bank. In fact, the CBA accounted for 42% of the rise in the total Australian market. Now, why was this? Well, CBA is pretty much domestically focused. The Australian economy is doing pretty well, so it's not really much of a bad debt cycle to be concerned about there. CBA's profits are rising, and it's been the recipient of a huge flow of index money into the stock. In contrast, look at BHP. Now, here's a stock that was down 10%, so that difference, a massive 60% difference between those two. Of course, we know BHP is globally focused, and in particular has a big exposure to China, and China's economy has been in the doldrums. BHP has also been buffeted by the uncertainty created by Trump's tariffs. What about dividends? Now, bear in mind, almost 50% of CBA shares are owned by retail investors, and to many retail investors, dividends are the most important thing that you think about. Have a look at this slide. Over the last 5 years, we see steadily increasing dividends from CBA, steadily declining, or maybe even not so steadily declining dividends BHP. The mining sector is basically part of the cycle now where it has to invest a lot of its profits for the future, and that's curtailing their ability to pay out on dividends. And this is another reason why we've seen the difference in performance. Having said that, CBA's been on a hell of a run, and now we're getting questions about, is it in a bubble? Apologies if this slide looks a little bit complex. What I'm trying to capture here is the relationship between a company's profitability and its market value. And generally speaking, you'd think that the more profitable a company is, the more valuable it's going to be. Have a look at some of the anomalies here. BHP and Rio actually make a lot more money than CBA, yet CBA is valued a lot higher. What is the market saying? It's saying that we expect the prospects of CBA to be much better than the prospects for those mining companies. What do I think? I think, look, the market might be right in terms of general direction, but I think it's wrong in terms of the actual gap between the two. Now, having said that, I said the same thing last year, and I was wrong. But if you say the same thing every year, one day you're going to be right. So I'm maintaining that that gap is indeed too wide, and I expect it to narrow this year. A couple of other predictions. I don't expect CBA to increase in value by another 50% this year. I'd be quite shocked. And for Australian dividend income, a 20% return last year was quite remarkable. Once again, I'd be quite surprised if we saw that sort of return next financial year. So it is a case of buyer beware. So let's get back to that initial question. How can markets stage such an impressive rally when there's so much bad news around? Well, I do tell people that as human beings, we live in the real world, but as investors, we invest in the financial world. And for periods of time, those two worlds can stay disconnected. Let me explain what I mean by that. What's important to real people? Well, things like this, things like the cost of living, my growth in wages, my mortgage payments. I get worried by war. Look at Mr. Market. Mr. Market's more interested in direction of things, direction of inflation, direction of interest rates, profit growth rather than wage growth. Let's look at that cost of living example. Now, I've got a bunch of colleagues that sit around me and they're complaining about the price of eggs, told that the price of eggs has doubled in the last few years. Now, that's a high inflation rate, and Mr. Market would be horrified with that inflation rate as well. But then what if I said inflation's actually going to be zero for the cost of eggs next year? Right? No change in price. Well, Mr. Market would be delighted with that. My colleagues are not. As far as they're concerned, the cost of eggs are double what it was a few years ago. And we see the difference in the way we view things in a market perspective versus a real-life example. So as it turns out, those key variables have all been trending in the right direction over the last year. Inflation has been falling, interest rates have been falling, and profits have been rising. And that's why the market has been able to stage quite an impressive rally with the backdrop of some pretty bad news. In July, there's still a positive tone to the market because those factors are still prevalent. However, there are some dark clouds on the horizon, and in particular, the impact of tariffs are starting to work through the system, and we expect the next few months are going to be quite telling in that regard. What are we doing? We are moderately adding to our cash levels, but we're not fundamentally changing our portfolio positions. We're sitting pretty tight. There's a wise old adage that timing the market is better than timing the market. It's an oldie but a goodie. Thank you very much for listening.